Markets strangely idle after fireworks last week cement the likelihood that there is a Fed interest rate cut on the way in September. This is Macro Money. I'm Ilya Spivak, head of global macro here at tastylive. And we are going to take a look at what these markets did last week, how to try to make sense of why they didn't do more with the information that they were given, and then consider what is likely to drive things going forward, because the conversation continues to focus on the very same conversation that we've been talking about for months and months and months, and that is, of course, interest rate cuts and the extent to which those cuts are coming from central banks, and most especially the Federal Reserve, and also, of course, the extent to which those cuts are meant as a welcome sign of victory over an inflationary spike of the past 2-3 years, or a worrying sign that the business cycle is starting to make the turn in a recessionary direction, and the cuts are meant to uplift, or at least to try to defend the economy from what is a gathering storm. So with that still as the key conversation, it is inflation data that we focus on this week. But before we do, let's first benchmark a little bit what we saw in last week's price action. Of course, we had a focus on the Fed with minutes from July's FOMC meeting, as well as that fateful speech from Fed Chair Powell at the Jackson Hole Symposium that the Fed holds annually as this kind of lens calibrating exercise, where the Fed Chair comes out once a year and marks important reshuffling or resetting of the sort of abiding driving thrust for monetary policy. And this year was, of course, no different. Powell came out and said, okay, let's really make this official now. We're ready to cut rates. We're not looking for the labor market to get any weaker than it already is. We're not seeking any more cooling there. We are now ready to begin to dial it back. What's interesting is how relatively timid the response from markets looks given that sort of guidance. S&P up just 1.3%. The NASDAQ not even managing a full percentage point gain, 0.9%. Yields down across the board, not surprisingly there, with most of the weakness in the front end, 3.3% lower in the 2-year, 2.1% in the 10-year. Crude oil looks like it was down last week, but of course it had been down more and is actually back up to higher levels now as we start this week. That seemingly a function of still churning geopolitical risk back and forth, a little bit more tension between Israel and Hezbollah over the weekend, and that giving crude a little bit of early gain here at the start of this week. So it continues to do its own thing. Gold, the dollar, all seeing somewhat of a tangential benefit to this conversation about rate cuts. Gold a little bit higher, albeit very modestly so. The dollar a little bit lower, again, relatively modestly so. And so we look at then a situation here where seemingly everything is doing the thing you would expect. Stocks higher, gold and bonds a little bit higher, yields a little bit lower, the dollar a little bit softer. All of that seems to kind of comport with rate cuts as the order of the day. But all of these moves are relatively modest, reflecting perhaps the idea that what we heard from the Fed last week really didn't move the needle very much, because a 25 basis point rate cut for September has been baked into expectations for quite some time. If we take a look at sort of the historical backdrop here, we've been looking to get down into a September rate cut at this point for the better part of a month and a half. Going all the way back to the middle of July is where we really seem to cement the idea that this September cut is coming. And the question more so on the minds of investors was whether we might get an outsized 50 basis point cut. And Fed Chair Powell didn't seem to take the possibility off the table, nor did he seem to endorse it, making next steps a volatile affair, because now we are going to be looking at a situation where so much hinges on just a handful of economic data releases and next week's jobs report in particular. And so perhaps the kind of timid price action that we saw last week speaks to the still lingering uncertainty around what was the big question and the kind of deflating confirmation of that which was, for the most part, already discounted in asset values. And so it is with this in mind that we look ahead at what's coming up this week, and we begin the focus outside of the US because there is a stream of inflation numbers coming here that introduce a sort of foil to the Fed narrative. We've seen the dollar weaken a lot as the focus has been in particular on Fed rate cuts, but now perhaps we're going to see a little bit more of the other side. And we begin in Australia, where we're looking at the monthly CPI indicator coming down to 3.4% according to expectations. That would be a meaningful move lower if we sort of consider this in relative terms. This would be the weakest number that we've seen since February. Now, the monthly indicator is not the big inflation number out of Australia. The RBA tends to focus on the longer running quarterly CPI series as its main kind of signpost for inflation. But nevertheless, this is an interesting set of figures because we get in the lead up to this data some very interesting PMI data last week where input costs seem to be rising, but output costs are falling. And so it seems as though businesses are absorbing rising input costs rather than pass them on, which speaks to a weakness in demand. Australian economic data has been also a little bit soggy relative to forecasts, although it's been back and forth in recent weeks. What's interesting here is if, in fact, you get a somewhat weaker number, or at least a number arguing in favor of an easier stance from the RBA, you run into the RBA itself, which has been busy attempting to talk down the possibility of rate cuts. Nevertheless, we can see here the markets are moving into a dovish direction over recent months. They've shifted a little bit to a more hawkish setting, modestly so now versus the August 6th policy meeting, largely because we had minutes from that meeting just released a few days ago, and there apparently was a conversation about hiking, not cutting rates. Ultimately, the RBA decided not to go that route, but there was enough of a concern about stickiness of inflation to spark the conversation. Nevertheless, we can see here we're at a somewhat more dovish setting than we were in June, the meeting before that. And so the preponderance of market thinking seems to be kind of tilted into a dovish sort of direction. Nevertheless, if we look at where the cuts are actually baked in, at 4.14 for the December implied rate in cash rate futures, we're only down about 21 basis points. So that's not even a full rate cut. It is most of a full rate cut, which would be 25 basis points, And we can see here that we're sort of, for the year as a whole, tilting in the direction of easing rather than the alternative, but we haven't gone very far. And what we need is indeed some sort of a piece of data to set this off. This, of course, comes at a very auspicious time when the Aussie sits squarely at July's high and seems to be reluctant to clear the way above it. If we then get a relatively soft CPI number, we might very well set the stage for a rethink, for some sense that the RBA is going to have to go where the markets are leading it here and acquiesce to a more dovish way going forward. To the extent that this cements a rate cut, at least one, finally, for this year, there could be a tradable top in the Aussie here, and so that'll be something to keep an eye on for the week. It would also be an important puzzle piece in the global easing story if yet another central bank is being pulled into the dovish conversation. The story about global growth and the need to respond to a deceleration broadens further still. That, of course, is yet another worry for stock markets, not one that is perhaps at the front and center of conversation, but certainly one that contributes to the atmospherics. We then shift gears to what comes of inflation data in Europe. Here, we are expected to see a 3-year low on CPI at 2.2%. That's after this kind of sluggish period here. We've seen very modest disinflation continuing in the Eurozone for much of this year, and even a little bit of a drift higher as this component here, the housing, water, electricity, and gas component, becomes once again a positive contributor, having been a disinflationary force earlier. Those rebasing effects, putting that back into the calculation. But as we get into what we are anticipating for July's numbers, it's looking like, or August numbers rather, it's looking like we get a return back to that disinflationary dynamic, 2.2% expected. Now, as far as what this does to near-term ECB policy expectations, the cut is effectively there. The current deposit rate, 3.75. By September, we're looking at a rate of 3.56. So we're almost all the way to a cut, about 20 basis points of the way there. So call it about 80-ish percent chance that the cut is going to happen. Where this gets interesting is we've paid a lot of attention to what Fed policy officials were saying at Jackson Hole, but there was, of course, also a ton of commentary from ECB officials, which were also at Jackson Hole. And some of the interesting comments, in particular from Bank of Finland Governor Olli Rehn, start to focus around the idea that maybe it isn't just one cut, that maybe it's the ECB that's going to do a jumbo rate cut in September. And that is not something that the markets are currently priced out for. We do have a sort of tilting in the direction of maybe 3 more cuts before year end. Yeah, if we take a look here at the cumulative outlook for the rest of the year, we can see 61 basis points are on the menu. So that's 50 basis points that are already in the forecast, as it were. And then 3 rate cuts would be 75 basis points, and we're obviously not quite there at 61, but the likelihood of that move is starting to gather steam at 14 basis points already baked in. We're essentially looking at about a 56% chance of a third cut. Now, that can take the form of a cut at each one of these meetings, a 25 basis point here, here, and here, or that can look like a 50 basis point cut in September and then one more at one of these meetings. So it'll be very interesting to look at what this does because, of course, the euro is in a similarly auspicious spot as the Aussie. It is sitting almost exactly at its highs from late last year. And so this then becomes a dollar rebound sort of candidate, perhaps looking ahead, because again, you've had so much focus on the US side of the equation, but if you were to get a further dovish drift from some of these counterparty central banks, then whatever modest reshuffling in US yield spreads has occurred over the past week or two gets eaten into, and the dollar's disadvantage gets somewhat erased. And then, of course, we shift to the US itself. Here we're going to get the PCE measure of inflation. This is the Fed's favorite gauge, but also the one with the least capacity for speculative surprise, because by the time these numbers come out, markets are generally fairly good at benchmarking what they're going to have there, having already seen CPI and PPI numbers for the same period. Expectation here is that we're going to hold at 2.5% at the headline for a second consecutive month, but that at the core, we might edge up a little bit from 2.6 to 2.7%. And as ever, the main question for this release is going to be whether we are in a 50 basis point kind of conversation or whether it'll be 25 basis points that gets done for the Fed what they want to achieve, at least in this next go round. And so while there's probably not a whole lot of scope for surprise because there's not much else on the calendar for the markets to do about this Fed conversation this week, there might be a little bit extra focus on this number, if only to get to the other side of it, to unlock whatever the markets feel they want to be doing anyway. So at the very least, it might be a waypoint for investors to sort of set the stage for whatever the markets want to do next once the event risk is in the rear view. As it stands here, we're looking at about a 30% chance that there is that 50 basis point cut in September and a 70% chance that we're going to get just the 25. So the hope here is still very much alive. And if we look at what this looks like, relatively speaking, we can see that over the recent months, there's been a steady push to a more dovish setting, and that continues to develop here. So we can see by November, it is of course a late September meeting, by November, that first cut is there, and we're even tilting in the direction of another. That would be that possibility for a 50. And then by the time we get to the end of the year, we're looking at substantial easing that then continues at a steady clip into the middle of next year, so that by the time we get to essentially the second half of next year, we've already moved to the tune of 2% almost on the headline rate. That still seems to be about where we anchor, though. The interesting part about this conversation recently is that we're still pinned to about 200 basis points in rate cuts, and this total isn't growing. Much of what we've seen has been reshuffling from 2024 to 2025, and in a curious way, the total hasn't budged much. So how the markets react to this data and to a lot of the incoming news flow here may have less to do with whether we're going to get more cuts or less, more to do with where those cuts are expected to appear. And that might start to twist the yield curve somewhat. If it seems like the Fed is biased to 25 basis points in September, then you probably get a little bit more strength for yields at the front end and weakness for the notes at that tenor. You probably rebuild a little bit of support for the U.S. dollar because its near-term yield story gets a little bit better. But because there seems to be something of a trade-off between how much easing there is this year and how much more of it then gets added for next year, you probably, as long as this kind of right sizing continues to hold, you probably then get a flattening of the yield curve where bonds do relatively better at the long end. And there is a sense that maybe the Fed is falling further behind the curve in delaying rate cuts, which might end up taking this sort of standstill that we see in stock markets and turning it into a little bit more of a defensive stance, not dissimilar from what happened here in the first half of July. And finally, something that is not exactly a macro event, but could be in the context of this week's developments. An earnings report from Nvidia is on the menu, and obviously this is not your traditional macro catalyst, but it is an important touch point for sentiment. The expectation here that we are going to get an EPS of 65 cents a share for the second quarter of the year. And the most interesting part here is perhaps that the magnitude for upside surprise for Nvidia has been edging lower. So as the markets move forward here, there's some sort of natural progression toward benchmarking what is normal. And as expectations increasingly line up with some semblance of that benchmarking, we get a sense that the markets sort of learn how Nvidia earnings are supposed to deviate quarter to quarter. And so the magnitude of surprise dwindles. If that continues, given how incredibly important the chip stocks and the AI story have been to risk appetite this year, you again run into the possibility of a kind of buy the rumor, sell the fact dynamic. It's a similar story looking at revenue numbers. They too have had this tendency over the recent quarters, not necessarily to miss, but to beat by a narrowing margin. And if that continues, it could take some speculative steam out of equities if the release ends up being somewhat underwhelming. And that is macro money for this week. At least that's what we think we're going to see. We will, of course, continue to build out as we come back and take each one of these catalysts one by one. We're here Monday through Thursday, right after Overtime, a show that I co-host with Chris Vecchio and Dylan Radigan, looking at the Wall Street close and where things go thereafter. I'll be back on with Victor Jones for The Price of Truth on Wednesday, back on with Chris for Futures Power Hour on Friday, joining Victor and Tom for First Call on Sundays, writing for the news and insights portion of tastylive.com, and opining sporadically on the platform formerly known as Twitter at Ilya Spivak. Thanks very much for joining. Macro Money is back tomorrow. Happy trading.